It is Friday, so that means it is time for your chart of the week. Okay, BK, you are flagging a big move for the financials.
Yeah, so for the first time since the crisis, actually since 2007, XLF has hit a new high. So it's taken almost 12 years to get all the way back up here. And what I think is interesting is a lot of people want to buy a breakout, and there's nothing wrong with that. But if you look at where the yield curve was when the financials topped out back in 2007, 2008, it was as flat as it is right now. And as the yield curve re-steepened, the financials actually sold off. So don't be fooled by financials breaking out and saying, hey, wait a second, if the yield curve steepens again, they're going to do really well. If you look back at history, they don't tend to do well. And actually, it's because when that re-steepening comes, that's when you get the potential for a recession coming.
So I think that's a real good point. I would make a point, though, that when the banks actually, when the yield curve inverted back in 2007 into 2000, you actually saw 2006 into 2007, you saw that the banks actually outperformed during that period, which was, of course, a prelude to a terrible run. I'm not suggesting that now. I think what makes now an interesting time for banks is that banks are back to where they were pre-crisis in terms of capital distribution. So in terms of dividends, in terms of their ability to do buybacks. Remember that last round of stress tests, even JP Morgan almost tried to fail that test because they wanted to be as aggressive as possible. That's what's bringing back, I think, big institutions into the sector because they can pay proper dips.
I think you look at the run that we've seen in these banks, it was tax cuts and deregulation. I think that's run its course. We're not going to see any more of that. And to your point, that was picture perfect today. They capped out exactly the same spot where they did back then. So I do believe you have to have a perfect world set up. And these returns have been great this year. I don't know if they could replicate these returns going forward, though.
Yeah, I would just be cautious. I mean, it doesn't mean you sell short. Doesn't mean we're going to have a banking crisis. I just, when a lot of people see something break out from 10, 12-year highs, they tend to want to buy that. In this case, I would use some caution.
I don't want to sort of beat the same drum, Tim Seymour, but this repo move, we got $150 billion coming in on December 31st and $150 billion more coming in on January 2nd. $300 billion being put in the overnight repo market. I know it's wonky, guys, but this is a big story. Some people think it's nothing. Some people think it's a lot. Where do you stand?
I think it's a lot. And I think we've talked about this on the show in the last couple of days. We talked about this yesterday. And I think you have a case where this type of liquidity has done two things. One is it's actually flooded liquidity into the market. It's also pushed down volatility, pushed people into the market. This is a risk, remember, because the minute the Fed starts to unwind this, they tried to tell you this was not QE again. It was stealth QE, and it's real, and it's been important for the equity market.
Okay.